Hello everyone, welcome back to Fundrise Finance. The last 1 month, that is the month of March, has been pretty volatile in the markets. The S&P 500 reached close to 4,050. Then we saw a stumble because of the banking crisis at Silicon Valley Bank and Signature that continued till middle of the month. And then we saw a nice little rally upwards, which lasted through end of March and also into this first week of April. So basically, the markets are slightly clueless where to go from here, which will mostly be dictated by where the inflation numbers are, what the job numbers are, and so on. But as disciplined dividend investors, we always keep searching for opportunities in the markets, look for undervalued dividend stocks that we want to get invested when they are at their lows, so that when the markets rebound, we're in the benefit. In today's video, we'll discuss 5 such great stocks that are undervalued at the moment. So before that, let's see how our dividend picks for the month of March have done. Here we had American Tower Corporation, AMT, Bank of America, BAC, Johnson & Johnson, J&J, Lowe's Companies, LOW, and Verizon Communications, VZ. Of these, Bank of America did the worst, down more than 18%. So just along with every other financial sector stock, Bank of America also got clobbered in the month of March. Then we had Lowe's performing negative, down 1.5%. And then we have the positive performers, Verizon Communications up 3.49, AMT up more than 4%, and J&J up more than 6%. So among these, we have one stock that's also part of our April list. To know which is that, stay tuned for the rest of the video. Without any further delay, let's give a look at what the picks for April are. So first on the list, we have the Toronto Dominion Bank, ticker symbol TD. Now, the Toronto Dominion Bank is one of the largest banks in Canada. So year to date, we see the TD Bank falling almost 8%. Last 1 year, it is down more than 25%. It has a market cap of $107.78 billion. Currently yields 4.66% at a forward PE of 9.01. From dividends perspective, TD Bank has been raising its dividend for the last 8 years at a 5-year dividend growth rate of 7.13% and a good payout ratio of 42.23%. So when we add up the current yield of 4.66% and the 5-year dividend growth rate of 7.13%, we get a value close to 12, which is the Chowder number. So this is a metric which I have recently been paying close attention to. What this does is basically it gives you a balance of dividend as well as the dividend growth rate, which is very crucial for a portfolio which wants to see a nice growth into the future. So I prefer a Chowder number closer to 12 or more for non-utility stocks and closer to 8 or more for utility stocks. So in this case, TD Bank matches my criteria. So from valuations perspective, Morningstar considers TD Bank a 4-star stock with a fair value of $72. Value Line has a midpoint price target of $69.56. That's the US dollar conversion from Canadian dollar. Likewise, CFRA considers TD Bank a 3-star hold with a converted price target of $49.58. As per my own calculations, which considers current and historical yields, averaging all these out, we get a final fair value of $64.97, which makes TD Bank currently undervalued by 10%. Second on the list, we have the Home Depot, ticker symbol HD. Now, Home Depot is from the consumer discretionary sector and is a home improvement retailer with its stores present countrywide. Year to date, we see Home Depot down almost 9%. In the last 1 year, it is down 3.33%. Last 5 years, it has a very good return of more than 67%. Home Depot has a market cap of $292.93 billion and currently yields 2.9% at a forward PE of 18.19. From dividends perspective, Home Depot has been raising its dividends for the last 13 years at a very good 5-year growth rate of 16.06%, which is more than double the current inflation rate. Even the payout ratio is good, it's 46.7%. So when we add up the dividend yield of 2.9% and the 5-year growth rate of 16%, we get a Chowder number which is closer to 19. That's really good. From valuations perspective, Morningstar considers Home Depot a 3-star stock with a fair value of $267. Value Line has a midpoint price target of $330. CFRA considers Home Depot a 4-star buy with a 12-month price target of $340. Likewise, Zacks has a 12-month price target of $304. As for my calculations, I found Home Depot to have a fair value of $356.03. Averaging all this out, we get a final fair value of $319.41. That makes Home Depot currently undervalued by 10.67%. Fourth on the list, we have Lowe's Companies Inc., ticker symbol LOW. Now, Lowe's, like Home Depot that we saw earlier, is one of the country's leading home retailer. Year to date, we see Lowe's almost flat, down 0.24%. Last 1 year, it's down more than 1%. Last 5 years, though, Lowe's has done tremendously well, up almost 133%. Lowe's has a market cap of $118.42 billion and currently yields 2.12% at a forward P of 14.45. From a dividends perspective, Lowe's has been raising its dividends for the last 59 years. That makes it a dividend king, which is a very exclusive group of companies who have been raising their dividend for more than 50 years. And the 5-year growth rate is amazingly high at 20.11%. The payout ratio is low at just under 29%. When we add up the current yield of 2.12% and the 5-year growth rate, we get a value that is more than 22, which is really great. Now, Lowe's has its ex-dividend date coming up soon on April 25th. So all the investors in Lowe's before this ex-dividend date will get paid $1.05 on May 10th. From valuations perspective, Morningstar considers Lowe's a 3-star stock with a fair value of $218. Value line has a midpoint price target of $240. CFRA considers Lowe's a 3-star hold with a 12-month price target of $235. Likewise, Zacks has a 12-month price target of $203. As for my own calculations, I found Lowe's to have a fair value of $246. Averaging all these, we get a final fair value of $228.40. That makes Lowe's undervalued by 13.71%. Third on the list, we have Union Pacific Corporation, ticker symbol UNP. Union Pacific is from the industrial sector and is one of the largest railroad operators in the country. Year to date, we see Union Pacific down almost 4.5%. Last 1 year, it is down more than 18%. The last 5 years, though, it has returned a healthy 53%. Union Pacific has a market cap of $121.22 billion, currently yields 2.62% at a forward PE of 17.24. From a dividends perspective, Union Pacific has been raising its dividends for the last 16 years, again at a very good 5-year growth rate of 14.83%, which is again double the current inflation rate, and the payout ratio is good at 45.28%. Now adding up the dividend yield of 2.6% and the 5-year growth rate of 14.83%, we get a chowder number of 17.5, which is really good. From valuations perspective, Morningstar considers Union Pacific a 3-star stock with a fair value of $203. Value line has a midpoint price target of $261. CFRA considers Union Pacific a 3-star hold with a 12-month price target of $223. Likewise, Zacks has a 12-month price target of $205. As for my calculations, I found Union Pacific to have a fair value of $243.54. Averaging all these, we get a final average fair value of $227.05. That makes Union Pacific currently undervalued by 14.3%. The fifth and final stock on our list is JPMorgan Chase, ticker symbol JPM. JPMorgan Chase is from the financial sector and is one of the country's leading financial services company. Year to date, we see JPMorgan down 5.66%. The last 1 year, it is down more than 3%. The last 5 years, it has returned almost 15.5%. JPMorgan Chase has a market cap of $375.19 billion and currently yields 3.14% at a forward PE of 10.04. From a dividends perspective, JPMorgan Chase has been raising its dividends for the last 8 years at a 5-year growth rate of 12.91% and a payout ratio of 33.11%. So when we add up the dividend yield of 3.14% and the 5-year growth rate of 12.91, we get a value close to 16, which is really good. From valuations perspective, Morningstar considers JPMorgan Chase a 4-star stock with a fair value of $146. Value line has a midpoint price target of $154. CFRA considers JPMorgan a 4-star buy with a 12-month price target of $156. Likewise, Zacks has a 12-month price target of $150. And as for my own calculations, I found JPMorgan to have a fair value of $137.54. Averaging all these, we get a final value of $148.71. That makes JPMorgan currently undervalued by 16.66%. So to summarize all the stocks we discussed today, we had Home Depot, HD, JPMorgan Chase, JPM, Lowe's Companies, LOW, Toronto Dominion Bank, TD, and Union Pacific Corporation, ticker symbol UNP. So like we saw, each of these stocks is undervalued at this moment and are great companies to invest into at this point. They're undervalued anywhere between 10 to 17%. So as always, I just keep telling you the same. Keep our investments disciplined and invest into companies which are undervalued at the moment, and that will lead to greater benefits in the long run. Hope you all found some value from this video, and if so, please click on that like and subscribe buttons so that YouTube can suggest this video to many more people out there. That will help out this young channel. I would really appreciate if you could also mention in the comment section what you liked about this video, which other ticker symbols do you want me to discuss about. Let's keep the interaction going on. And so until we meet in the next video, let's try to be healthy as much as possible financially and keep taking those small strides towards financial freedom. See you. Bye.